taxes. It's a topic that can leave most of us scratching our heads and reaching deep into our pockets. But then, you hear stories of billionaires like Jeff Bezos and Donald Trump who managed to pay little to no taxes at all. How do they do it? And more importantly, how can you save more of your hard-earned money too? Today, we are going to dive deep into the legal tax strategies that the rich use and uncover some smart tax savings tips for regular folks like you and me. By the end of this video, you will understand how the wealthy minimize taxes legally and how you can use similar strategies to keep more of your own money. Stick around and don't forget to subscribe for more finance insights every week. So let's start by understanding one of the most important concepts when it comes to taxes. Not all income is created equal. According to Robert Kiyosaki, author of Rich Dad Poor Dad, there are 4 different types of income that fall into what he calls the cash flow quadrant. The key is knowing which type of income you earn because it will dramatically affect how much tax you pay. Let's break this down. Number 1. Employees. If you are an employee, most of your income comes from your salary, which is taxed at the highest rates. The more you earn, the higher your tax bracket. But that's a catch. Only the portion of your income that exceeds each tax bracket is taxed at that rate, not your entire income. So if you are making $100,000 and the 24% tax rate starts at $90,000, only $10,000 is taxed at 24%. But employees can still lower their taxable income by investing in retirement accounts like a 401k or an IRA. These allow you to defer paying taxes until retirement, meaning you will be taxed at a lower rate when you are likely earning less. Number 2. Self-employed. Now, if you are self-employed, you have a bit more flexibility. You can deduct business expenses such as home office costs, transportations, and travel. However, you are also subject to self-employment taxes, which can add up. This means that when you have more deductions, you also face extra taxes that employees don't have to worry about. Number 3. Business owners. Business owners often have the most opportunities for tax savings. Corporations, in particular, can take advantage of numerous tax breaks, including deductions for research and development, employee salaries, and even interest payments on loans. Business owners can also pay themselves a salary which is taxed like any other employee, but they can pay themselves dividends too, often taxed at a much lower rate. Number 4. Investors. And then there are investors. This group pays the least in taxes by leveraging capital gains, especially long-term capital gains, which are taxed at lower rates than ordinary income. For example, if you hold on to a stock or a property for more than a year, you could pay a tax rate of just 15% or even 0% in some cases, depending on your total income. So how do the ultra-wealthy like Jeff Bezos, Elon Musk legally avoid paying much in taxes? Let's take a look at some of the sophisticated methods they use, methods that are completely within the bounds of the law. Number 1. Leveraging capital gains. One of the most common strategies used by the wealthy is to make the bulk of their money from capital gains. Since the tax rate on long-term capital gains is much lower than the tax rate on regular income, they end up paying less tax even though they are making millions or even billions of dollars. What's more, if they hold on to their investments for over a year, they might qualify for even lower tax rates. Number 2. Real estate holdings. Here's a little known fact. McDonald's isn't just about burgers and fries. The company makes a fortune from real estate. By owning the land where franchisees operate, McDonald's collects rent from franchises. This means they benefit from real estate tax breaks while continuing to profit from their food business. Many wealthy individuals like McDonald's invest in real estate for similar tax benefits, depreciation, capital gain tax breaks, and even tax-free exchanges when they reinvest their profits. Number 3. Offshore tax strategies. And then of course, there are offshore tax strategies. Some billionaires set up sophisticated legal structures in countries with low or no taxes, allowing them to shift profits away from the US and avoid higher tax rates. Now, this is a method most of us can't use, but it's perfectly legal and widely practiced by the wealthiest individuals. Now, if you are an investor, there are even more ways to save on taxes. Let's take a look at a few key strategies. Number 1. Harvesting capital losses. Did you know that you can actually benefit from losing money in the stock market? If you sell investments at a loss, you can offset those losses against your gains. And if your losses exceed your gains, you can deduct up to $3,000 from your taxable income. Any excess losses can be carried forward to future years. Number 2. Holding investments for long-term capital gains. Here's a simple trick. Hold on to your investments for more than a year to take advantage of lower long-term capital gains tax rates. Depending on your income, long-term capital gains might be taxed at just 0%, 15%, or 20%, far lower than ordinary income tax rates. Number 3. Maximize your 1099B accuracy. If you are an active investor, always double-check your 1099B forms from your broker. These forms report your capital gains and losses to the IRS, but sometimes they miss key information like the cost basis of your investments. If the cost basis isn't included, you could end up over-reporting your gains and paying more tax than you owe. Alright, now let's talk about how you, as an average taxpayer, can reduce your tax bill legally. You don't need offshore entities or an army of accountants to save money. Here are some straightforward strategies anyone can use. Number 1. Commuter benefits. Does your workplace offers commuter benefits? If so, you can spend up to $300 per month tax-free on commuting expenses like public transportation or even parking. That's up to $3,600 a year in savings. Number 2. Retirement plans. Make sure you're taking advantage of any retirement plans your employer offers, like a 401k or 403b. Every dollar you put into these accounts lowers your taxable income for the year, meaning you pay less to the IRS. Number 3. Health savings accounts. If you have a high deductible health plan, consider opening a health savings account. The money you contribute is tax deductible, and if you use it for qualified medical expenses, you don't pay taxes on it ever. Plus, any money left in the account can be invested, and those investments grow tax-free. Number 4. Flexible spending accounts. FSAs work similarly to health savings accounts, letting you pay for healthcare expenses with pre-tax money. Just be careful. FSAs come with a use it or lose it rule. If you don't spend all the money by the end of the year, you could lose those funds. Number 5. Dependent care FSA. If you are a parent, you can use a dependent care FSA to pay for childcare expenses like daycare or after-school programs with pre-tax money. This can save you a lot, especially if you are juggling work and family life. So let's wrap up with a few more quick hacks that can make a big difference when tax season rolls around. Number 1. Adjust your W-4. When was the last time you updated your W-4 form at work? If you are getting a big tax refund every year, it means you have been giving the government an interest-free loan. By adjusting your W-4, you can keep more of your paycheck throughout the year and invest it, rather than waiting for a refund. Number 2. Minimal rental use rule. If you rent out your home or vacation property for less than 14 days a year, the IRS doesn't require you to report the income, meaning it's completely tax-free. This is often called the minimal rental use rule, and it's a great way to earn some extra cash without worrying about the tax implications. Number 3. Tax-free gifts. Want to help a loved one financially? The IRS allows you to gift up to $17,000 per year per person without incurring any gift taxes. You can give this money to anyone, your kids, grandkids, or friends, tax-free. It's a simple but powerful way to help someone out and reduce your taxable estate at the same time. So there you have it. From capital gain strategies to smart savings accounts and retirement plans, there are plenty of ways to reduce your tax bill and keep more money in your pocket. The key is understanding the rules and using them to your advantage. The wealthy know these tricks, and now so do you. If you found this video helpful, give it a thumbs up, share it with someone who could use some tax tips, and don't forget to hit that subscribe button and ring the bell for more financial advice. Let's work together to keep more of your hard-earned money where it belongs, in your pocket.